CNBC exclusive is JLL CEO Christian Ulbrich. Christian, thanks for being on the show with us. Let's start with that. The fact that we are seeing this constriction in terms of capital and what that means for transactions. We've been talking about the regional banks. We've been talking about tightening credit conditions. What are you seeing in real time?
Good morning, Morgan. Well, you have seen the transaction volumes, which have come down very significantly, around globally 60%. But we also see some green shoots. The U.S. has adjusted in pricing relatively quickly. The debt markets are gradually coming back. We see now bigger transaction on the debt side working again. And so we will work ourselves out of that very low first quarter this year, and you will see a constant improvement over the remainder of the year.
So in terms of commercial real estate market more broadly, and I realize there's many different buckets here, but it almost seems like there's this bifurcation beginning to emerge between Class A, whether it's office space, whether it's retail space, et cetera, and then everything else. Is that the case? And if so, what does that mean in terms of the dynamics here more broadly in the real estate market?
Yeah, we have been talking about that bifurcation now for some time, and that will continue to be a very important trend. We had in 22 a pretty amazing statistic that vacancy rates globally in all the major markets of the world have gone up. And at the same time, top rents have also increased. Usually those two things don't work together, but we have seen that last year, and that will be a trend of the coming years. This is a reflection of the bifurcation between top quality buildings, where the best companies of the world are trying to get in, and then those buildings who are not meeting expectations of today's tenants anymore, where rents will come down or they will stay vacant. And that has obviously an impact on the investment markets as well, where those buildings will continue to trade, which will meet tenant expectations for the medium and long term. And those buildings who are not meeting those expectations, where the upgrading makes no financial sense, they will just not trade and values will continue to come down.
And I want to dig into that piece of the puzzle a little bit deeper, because what happens if those buildings aren't traded, if vacancies stay elevated, if you have landlords and investors that aren't necessarily going to put money into those upgrades? Do they go back to the banks or to the lenders? And are the lenders even going to want those on their balance sheets?
Well, first of all, people will try to find out whether you can turn those buildings into something else. So you will continue to see office buildings being turned into resi buildings because we still have a high demand for residential space. You will see those buildings turn into hotels and all kinds of usages. But there will be buildings where there is no financial case to turn them into something else. And so somebody will have to take the pain. Obviously, the equity will be wiped out. They will go back to the lenders, and then they will have to take a write down on those buildings. And at some point, they will probably be demolished and something else will happen around those sites. But this is a lengthy process, and we will see that as one continuum over the next couple of years. But it shouldn't distract from the fact that we have a huge amount of buildings which have a purpose and where there is demand for those buildings on the leasing side as well as on the investment side.
Okay. Christian Ulbrich, JLL CEO, thanks for joining us today.
Thank you.